Welcome to Advanced Real Estate Mastery. In Chapter 1, we understood real estate. In Chapter 2, we executed strategy and scaled portfolios. Wait, before we dive in, if you care about building wealth through real estate, hit that like button now and subscribe for powerful insights. Let's get started. Today, we step into a different dimension. We move from investing in property to controlling projects, because there is a difference between owning assets and creating them. Welcome to Advanced Real Estate Mastery. As an investor, I buy existing value. I earn from appreciation. That's the key difference. Our developers are the engine of value creation, and they give us the power to control our margins. Let's leverage that. An investor acquires value. A developer manufactures value. When you buy a finished property, profit is already partially priced in. When you develop, you control design, cost structure, and exit price. Development increases both risk and reward, and that is why structure becomes even more critical. Let's review the 5 phases of development: land acquisition, feasibility, financing, construction, and exit. This ensures a profitable project. Development is a system. You do not start building because land is available. You start because the numbers justify construction. Feasibility comes before foundation. We must analyze market demand and construction costs against the projected selling price. Timeline and risk exposure are critical to our strategy. Development without feasibility is gambling. We must ensure our strategies are grounded in data. Development requires strategic partnerships, equity partners, landowners, and contractors. Without financial institutions, it's gambling. No large-scale real estate empire is built alone. Partnership multiplies capacity. A landowner may contribute land, an investor contributes capital, a developer contributes expertise. When structured properly, joint ventures accelerate growth without over-leveraging yourself. But clarity is essential. Roles must be defined, profit must be structured, risk must be documented. At this stage, real estate stops being a side investment. It becomes a business. Let's establish our key systems: legal structure, accounting, project management, marketing. These foundations will integrate our operations and drive our strategy. Team, our transaction metrics look strong. Now, let's shift to operations for efficiency gains. The data shows where we can optimize. This is how sustainability is created. Through our analysis, collaboration, and strategic planning, this is our impact. Today, we'll cover legacy planning, starting with asset protection and estate structuring, then long-term holds and intergenerational transfer. True wealth is not measured by the number of properties you own. It is measured by what remains after you are gone. Legacy investors think beyond income. They think about asset protection, succession planning, and long-term holds in prime locations. Real estate is one of the few assets that can transfer power across generations. Market cycles have 4 key phases. First, expansion, then a peak, followed by a correction, and finally, recovery. Markets move in cycles. The intelligent investor studies cycles, not headlines. You buy strategically during correction, you develop during recovery, you exit selectively at peak. Timing does not require perfection, it requires awareness. At advanced levels, success is no longer about information. It is about discipline. You will face delays, regulatory shifts, market fluctuations. The difference between collapse and growth is structure. Chapter 1 taught you understanding. Chapter 2 taught you execution. Chapter 3 teaches you control. Control of development, control of legacy. The future of real estate belongs to those who build intelligently, not emotionally. And when you move from buying property to creating value, you no longer participate in the market. You shape it. Thank you.